G'day there, Wealth Press subscribers, viewers, traders, and investors. I've got a special guest for us here today. Mr. Ed Coyne is the head of global sales for Sprott Asset Management. Ed, how are you today?
I'm doing well. How are you?
I'm fantastic, thank you. Ed, you have a particular expertise in the gold market, as I understand.
I suppose I do, yes.
The increase in the price of gold post-stimulus, $3.2 trillion in direct stimulus, some call it $30 trillion in indirect and fiscal stimulus globally, caused gold to rise in price by 10% year on year after the stimulus. So if there's going to be another stimulus event or a series of stimulus events, is it safe to say that we can expect a 10% increase in the price of gold in the near term? And then looking beyond that, we can expect it to be sort of commensurate with the levels and the frequency of stimulus?
Sure. Well, one of the things I've learned being a gold, investor is that gold's not a trained monkey. So it won't necessarily go up directly in correlation with how much stimulus comes out, or if the dollar is weak, or if the dollar is strong, or if rates are rising or declining. In fact, we've seen environments with rising interest rates where gold did very well. So it all comes back to the reason behind all those actions. So with more stimulus, if rates start going up, those things can all be bullish for gold. So we look at the overall narrative and look at how investors are thinking about gold today. And we really think we're in the second and soon to be third phase of what we call a super cycle, which really started in 2000. And from 2000 to 2008, gold slowly moved forward. And then from 2008 to 2011, it really accelerated. Then we had that pause from 11 to 15. And then we started to see it happen all over again. It all comes back down to how we are managing our monetary balance sheet. How are we managing the stimulus? How are we managing the debt levels? How are we managing interest rates, whether it's Fed fund rates or real rates? So in that environment, yes, we think gold looks attractive. I'm reluctant to put a percentage on the move. We have seen gold stair-stepping up every couple quarters to a new floor effectively. We think this 1900, 1950 seems to be the floor right now. The market's throwing everything at it, and gold continues to hold its own there. So we think new highs are certainly in its future in the next 1 to 3 quarters. And we think that's going to continue. And that bodes well also for gold equities, where the cost of extraction or all-in sustaining cost is about $900 to $1,100 an ounce, depending on the mine and the location and what type of open or closed pit it is and so forth. But it looks very attractive in our mind over the next 3 to 5 years, with the assumption that we're going to have lower for longer rates, that we're going to continue to have stimulus, that we're going to continue to have a challenged GDP globally, if not just in the US, but globally. All those things look good for gold. So yes, we think it's going to continue to march forward, but I'm reluctant to put a percentage on the move itself.
Sure. There's been quite a proliferation of academic papers emanating from the likes of the World Bank and the IMF, increasingly discussing the idea of replacing certain currencies with a central bank digital currency.
Yeah.
And I find this interesting because to me, that just screams that gold is going to be a beneficiary of that move. But what does that signify to you?
Well, I think you're right. I mean, first of all, if we move in that direction, the control shifts from the government to the people, which when you come down to currencies, we never want to see that happen. When I say we mean the government never wants to see that happen. That will bode very well for gold. Anytime a currency is challenged, anytime the value of a currency is challenged, is it authentic? Is it real? Does it have purchasing power? Does it have a store of value? Anytime those types of things are challenged, we're seeing it in Bitcoin, for example, right now that's bidding up. When those environments happen, when there's lack of trust in the system itself, not to go down the rabbit hole of conspiracy theories and so forth, but the reality is when people start to question anything, whether it's the election outcome, how it's being conducted, whether it's the value of the currencies, whether it's we're printing up too much money, whatever that case may be, those things tend to favor not just gold, but real assets, tangible assets in general, where people start to move away from a paper currency, a paper type of market. Things like crypto, things like physical metal and so forth become more and more interesting. So there's a lot of things that are putting wind in the gold sail right now.
Sure, you bet. And then talking about the miners a bit more, Joe Biden's victory, if it is in fact confirmed, suggests that there could be more of a regulatory environment surrounding the extractive industries, though he is limited in his agenda by the fact that it looks like the Senate will remain under, Congress will remain under Republican control. But the price of gold always seems to have a rather a dramatic uplifting effect on the price of gold equities, miners, et cetera. And you mentioned that that's your expectation again. So for investors looking to place capital, I mean, I've always viewed holding physical gold as a great way to preserve wealth, and deploying capital into equities is a great way to to make money with a relative degree of certainty in a rising gold market. And so does that sort of thesis still remain intact for investors?
It does. We talk to a lot of private families, institutions, endowments. More recently, advisors and brokers are starting to pay attention to the gold trade again. And the first comment we typically hear or we have with an investor or a prospective investor is physical first. And we say physical first because physical really belongs in the core bucket of your portfolio. So when you think about a lot of advisors and investors today, they have a core bucket that they're allocating to, and then they have a tactical or opportunistic bucket. The physical really belongs in that core bucket because traditionally gold has been a natural hedge to the volatility of the traditional stock market. But with rates where they are today and probably remaining here for quite some time, we're also seeing gold start to fill the role of a bond enhancement or even a bond replacement for some investors. And for our foreign investors or international investors that don't hold US dollars, they're seeing gold as actually a complement to their currency. So the physical allocation today is a very important component to the overall building blocks of a portfolio. Having said that, that's your core allocation, right? That should be 3 to 5% of your portfolio, regardless of where we are in the environment, regardless of the directional price of gold. If you manage that allocation and dial it up or dial it down and maintain that 5% allocation, it will be a very effective hedge in your overall portfolio. Now, in times of stress to the gold market, you may not want to own gold equities because they are very volatile. But in times like we're seeing right now, we're in much more of a bullish phase, you want to be thinking tactically about how can you participate in the gold market through equities. And we think equities look very attractive today because, as I mentioned earlier, the price of extraction right now, all-in sustaining cost, is between $900 and $1,100 an ounce. Gold is trading between $1,900 and $2,000 an ounce today. They have a lot of free cash flow. They've lowered their leverage, they've lowered their debt and their balance sheets. A lot of the senior management in these mining companies has been replaced from the 2011, kind of acquire at any cost. So you've got better balance sheets out there, and you've got players like Buffett now coming into the space buying Barrick, for example. You're seeing more and more serious investors look at gold equities for the first time. They've got margin expansion, they have free cash flow. Some are paying one-time dividends, some are creating dividend payout policies. So the balance sheets of these companies look very different than they did in 2011. And we think the opportunity for them to continue to grow looks very attractive because of the global narrative for the physical market. So physical first, equities second, physical as a core, equities as a tactical opportunistic allocation for sure. And we think the next 3 to 5 years could be very attractive for the space.
Sure. Let's talk a bit about the longer term picture for purchasing power in the US dollar. Dr. Carmen Reinhart, who is now the chief economist of the World Bank, wrote a paper back in 2008, I believe was the first version, called Financial Repression, where she talks about this idea that governments, through their central banks, offload the negative impacts of excessive debt onto the savers in their societies through ultra low interest rates. And certainly that has been the case in the current context of the last decade. Does that indicate, in combination with stimulus, which essentially is a proliferation of the fiat currency, along with negative interest rate, does that bode very negatively for the purchasing power in the US dollar, and therefore create an expectation for higher inflation, and again, reinforcing the whole argument for gold as a wealth preservation strategy?
It does, and I suspect when that letter was first penned, modern monetary theory wasn't a concept back then. This idea that we'll just print our way out of debt, that certainly flies in the face of Econ 101 that I took my freshman year at college. This idea that we're just going to print our way out of it, we're going to create more dollars and so forth. Long term, it doesn't work, right? We know it doesn't work. We've seen what the purchasing power of a dollar is. You can go back and look at a gallon of gas, a movie ticket, you know, a cheeseburger, a milkshake from 5 years ago to 10 years ago to 30 years ago. And what's interesting is a dollar doesn't buy what it used to buy back then. And that's the reality of all fiat currencies, right? It's simply just it's actually a Greek term, believe it or not, that says because we say it's so, that's what fiat means.
Right.
So if a government says it's worth $10, it's worth $10. But if you keep printing it, that $10 doesn't buy you as much as it once did. The beauty of gold is if you look at it over decades and decades and multiple cycles and centuries, frankly, it's maintained that purchasing power, it's maintained that value. So, you know, if you look at the returns of what gold has produced in the last 2 decades, for example, it's been one of the best performing assets out there. Yellow rocks are beating a lot of intellectual capital out there right now. And this goes back to exactly what you just suggested, a store of value. And that's really, at the end of the day, particularly wealthy endowments and families and so forth, they have the money, they want to make sure they keep their money. And gold serves a very important role in that type of diversification, that type of allocation. So yeah, I think you're spot on. I think the dollar, you know, whether it goes up or down, its overall purchasing power, its overall store of value continues to get diluted. You have to invest those dollars in something else, whether it's bonds or stocks, to increase its value. So the dollar on its own is going to continue to erode from a purchasing power standpoint for sure.
You bet. All right, Ed, let's leave it there for now. That's a great contribution. We're going to come back to you soon. Thank you very much for your time today.
Yeah, thanks for having me.